Okay, good morning everyone. Thank you very much for joining us for an early start this Monday morning for this year's IRLA panel session. Today the panel are going to be discussing perspectives on retrospective and legacy solutions. Before we start, just some brief housekeeping points. If we could please ask you to just turn your mobile phones onto silent. And if you've got any questions, we'll have some time at the end of the session for you to ask those to the panel. And finally, if you've got any questions about IRLA or IRLA membership, then please feel free to speak to either myself or my fellow IRLA directors, James Bolton, who's at the front here, Kevin Gill, who's on the panel, and Jenny Fair, who is on the desk at the front. IRLA membership is open to those in the legacy market, but as well to those in the live market. And for those who've got a European presence, we've got an event in Munich, which we'd be happy to discuss with you. So I'll now pass over to Kevin to introduce the panel, and we'll get the session rolling.
Thank you, Richard. Good morning, everybody. Very warm welcome to this panel session. For those of you who have come here before, we typically do a Q&A session throughout the panel, but I thought we would change things around this year. We have our annual Congress in Brighton, and my feeling and my takeaway from that Congress this year was a very positive outlook for the sector. So I thought this year, rather than have a Q&A panel, we would ask panel members to give their perspectives on the marketplace and see if the feelings I took away from Brighton are still with us and resonate across the sector. So if I maybe just ask the panel to introduce themselves. Jonathan?
Hi, good morning, everyone. I'm Jonathan Drake. I'm a partner in DWF, which is an international legal advisor and legal operations firm with a particular focus on insurance and reinsurance, and I have a significant background in legal issues in the legacy market.
Rachel?
Good morning. Is this loud enough? Rachel Barden. I am Chief Underwriting Officer for Compre as of last week. So I'm brand new on the job. Prior to that, I was with Hudson Structured, an asset manager investing in the insurance space for 10 years. And so I'm going to be looking at this from the investor perspective.
Morning, everyone. My name's Steve Ryland. I'm Managing Director of Acrisure Corporate Advisory Solutions in London. And I'm Global Head of Retrospective Solutions. I've been in this reinsurance industry for 35 to 40 years, which is incredible, mainly due to age, not ability. I structured my first LPT in 2002 at the age of 11. I was the former Catalina UK CEO, and then I was the global head of origination for Catalina. I'm currently active on 3 live deals, 1 in Europe, 1 in the UK, 1 in Lloyd's, and 2 US pending. So it's super busy.
Good. You're finally getting right in, Steve.
Yeah, I think so.
Andy?
Thanks, Kevin, and good morning, everyone. So for those of you who don't know me, my name is Andy Creed. I'm Riverstone International's UK CEO and Group CFO. I joined Riverstone back in 2013, so I've been in this legacy market for 12 years now. At the time, Riverstone was owned by Fairfax, and our primary role then was really an internal bad bank. We did do some third-party transactions, but we did also look after a lot of Fairfax liabilities. In 2021, we were acquired by CVC, so we're taken private by private equity, and we've been on a bit of a growth journey since then and been active in acquiring lots of individual transactions over the last 4 or 5 years, with more to come.
Thank you. And we should have David Flounder on the end from Howdens to give his more macro perspective of the marketplace, but he's not here yet, so we'll see. He might make a final appearance, but he's last up anyway, so he may be just making an appearance when we get there. Anyway, so why don't we just kick off? Andy, you said you're a major carrier in the marketplace. Why don't you give us your perspective on the marketplace?
Yeah, great. Thanks, Kevin. So I'm going to give you a few of my thoughts on the trend and outlook for large retrospective non-life reinsurance activity. And in this case, by large, I mean deals of over $1 billion. What I'm going to say will probably apply to deals much smaller than that as well, but I'll just take you through some of my thoughts. So in terms of large deals, what we've seen over the last few years, definitely seeing a trend of at least 2 to 3 large deals every couple of years, which is positive for the market. Generally speaking, we're seeing those cedants being North American, so Bermudian and US. We did see 1 large Lloyd's transaction over $1 billion done at the start of 2023, which Riverstone did with Amlin, but that was a little bit of an anomaly for Lloyd's markets. RITCs at that scale, not usually typical, but certainly a market that we would like to encourage to do more larger deals. In terms of the way that these deals are being brought to market, there are different structures and variant structures that we're seeing with no real fixed approach. really driven by a number of factors, including cedant motivations, different infrastructures on both the buyer and the seller side, and also different pricing dynamics that come into play. Just thinking through some of those different structures and what they tell us about appetite and deal flow. So in terms of core structure first, so a real mix of adverse development covers and lost portfolio transfers. Both can deliver capital relief and earnings protection, so we continue to see both a desire from cedants to achieve both of those factors in the deals that they're doing, but also a bit of flexibility here. So some of these deals are being brought to market without a fixed structure in place, which really provides a cedant opportunism on pricing, depending on works well for the buyer and the cedant. Operationally, ADCs tend to be typically easier, and that's particularly the case if claims control is not being ceded over to the buyer. From a Riverstone perspective, we typically like to take claims control, but we're seeing a lot more deals where, we can work with claims cooperation and work closely with the buyer without taking full claims control, but to still deliver good value. From a collateral point of view, most of the cedants still looking to achieve nil credit risk, and you typically get that around 120% collateral cover. We might see that change a little bit more. We're continuing to see a lot more legacy markets become rated now and pick up rated carriers. It's not something we've done at Riverstone at the moment, but certainly something we're exploring, and that might lead to a change in the way that these deals are being collateralized. And then from a limits perspective as well, just in terms of thinking about what that tells us about the cedants, we're seeing limits on these deals typically set around the 1 in 200, so still seeing cedants again looking for full capital relief, generally alongside earnings protection when they're entering into these transactions. In terms of what's driving deal flow, from a legacy market perspective, definitely the case that there is more appetite. There are more players out there now capable of writing these large deals, which is helpful for the cedants. That provides a wider set of market pricing for the cedants in terms of what they consider, but also reduces their concentration risk. So the live market's ability to transact with a broader set of legacy specialists in terms of doing deals, large deals, gives them the opportunity to be selective there. Our appetite is definitely driven by capital availability. I mentioned at the start that we were acquired by CVC back in 2021, and CVC have certainly backed us with capital, both their own capital and third-party capital that we brought into the business to enable us to do these large deals, but also definitely seeing continued increased sophistication and build out of strong infrastructure operations in the legacy market, which is more than capable of supporting large deals and being a very good custodian for the live market business. Couple of key factors from a balance sheet perspective driving deal flow that you'd obviously expect me to talk about. So from a reserving side, we've certainly seen quite a lot of US casualty strengthening in the live market over the last few years, and certainly looking for cedants to lock that in after that strengthening and bringing deals to the market, to the legacy market after that, allowing them to remove their volatility. And it's certainly the case that from our side, from Riverstone's side, the legacy market has become a lot more comfortable with taking on large books of business and being comfortable with where we have a view on the best estimate that those reserves sitting into the future. And then on the investment side, from a balance sheet perspective, it's definitely our perspective that a lot of the unrealised mark-to-market losses that arose from 21 onwards when rates started to rise have now largely unwound. That makes it a lot easier for cedants to transfer a large block of assets to the legacy market because they're no longer obligated to crystallise realised gains, which is certainly helpful in terms of structuring. But equally as well, high interest rates remain, and that makes the upfront economics for a lot of large legacy deals favourable. When investment return is driving a lot of economics on these deals from an asset leverage point of view, that reduces typically the upfront risk premium that the legacy market would demand, which is certainly favourable for the live market in terms of seeking deal flow here. In terms of where we might go, some influencing factors. I wish I had a crystal ball, but I don't. But certainly macro shocks will make a difference here. I mean, we live in a very volatile world, so any major change in interest rates, inflation and/or credit spreads, I think will certainly drive deal flow. One other factor which I think will be really interesting is where cat and reinsurance loss events go. We haven't seen a really large cat or reinsurance loss event for some time. There's a lot of new alternative capital flowing into that space in the last few years that's never suffered a large loss. It will be interesting to see that if it does take one, whether or not that capital retreats, and if it does so, that may leave the live market with a tighter capital facing position, and the legacy market would certainly be here to support provision of capital relief solutions at that time. Regulatory influences play a part. I mean, our perspective is that generally regulators are not trying at all to stop large deals. In fact, they're quite supportive of that, and they think they have seen that it's a good place for for policyholder protection to be achieved, but nevertheless, regulators are gatekeepers for these transactions, and any change in the regulatory outlook, including increased scrutiny, change in rules, or any change in cross-border coordination as well, could definitely have an impact on deals. But we continue to work with regulators to encourage them to support these transactions, and from our perspective, they generally remain positive. And then just on escalating litigation and emerging exposures, of course, it continues to be volatile. There's continued activity across latent and long tail lines, including PFAS, climate change, and opioids. And any change in certainty here or any trends away from or towards predictable outcomes will certainly influence the deal flow that we continue to see. What can we do about it? So there's a few things that I think about when I think about how we might encourage more deals to come to market. And I think about that in terms of how we work with our sellers, but also how we think about it as buyers. From a seller point of view, certainly encourage sellers to continue to work on the data transparency. Data transparency makes a huge difference to our ability to price accurately, but also leads to much faster execution, which allows us to get these deals done in a good way. Structural flexibility is super key as well. And we've spent a lot of time working on that to make sure that we're able to engage in the right way. I mean, ultimately, what we're looking to do here is to create a transaction that's not a zero-sum game. It has to be a transaction that elevates value for both sides, and that means making sure that the cedants and ourselves are well engaged to know where we can add that incremental value, be it across asset management, claims management, capital, or operations. So making sure we're engaged on those things is really important. And then from our side, we continue to invest heavily in our analytics and operations just to make sure that we're capable and continue to be capable of taking on large deals, and always on our claims expertise, where a differentiated offering is one of the key things that we think makes the legacy market different. And then just my final takeaways, just to wrap up. So from a demand side, absolutely sure that demand for large deals will remain. In fact, from my perspective, we would welcome more deal flow. I'd love to see 5, 6, greater than $1 billion deals being brought to market each year. From a supply side, I think there's no single factor that will drive the outcome here, and interplay will matter. I've touched on capital, and I think the tightening of capital in the live market will certainly drive more deals. Any change in reserve uncertainty will as well as any regulatory clarity. And then just from a structural point of view, I do think that the structure of these deals is continuing to be going to be very bespoke every time they're done, going to be a mix of LPTs, ADCs, and other structural impacts that will mean that we can add all of the value that I've talked about adding across these deals in general. Thank you.
Thank you, Andy. Thank you. Maybe to move to Rachel now, because you've been an investor into this market for a while now. You're on the carrier side. So what's your perspective?
Yeah, sure. So just a little bit of background. Compre is a specialty reinsurer who provides claim solutions in the runoff space and capital solutions across the P&C sector. I've known and invested in Compre for about 6 years as an investor through debt and equity, so I've known the team for a while. So I'm super excited to join them. I think very highly of the team. I'll be working with the origination, M&A, and pricing team. But since I've been on the job for 1 week, I thought I would talk about the legacy market from the perspective of an investor who invests in insurance companies and why your stakeholders want you to have this product. So what benefits can the legacy product offer insurance companies from the investor's perspective? There's multiple ways. One, narrow the range of uncertainty on prior year results and build in the cost of exit. 2, recycle capital from reserves to capital for underwriting new business with profit potential, essentially managing the opportunity cost of capital used efficiently. Reduce operational frictions, such as claims departments for old lines of business. 4, return the investor and management focus from prior year management to forward-looking prospects. I think this last one is not well appreciated. This helps to turn senior management and the investors' perspective from putting out fires to building empires instead. And 5, providing exit options outside of the operating insurance company balance sheet arena in blocks, sidecars, funds, LPA funds. So how does the legacy market help shareholders and LPs of insurance companies and funds to realize their value? We need to attract other investors at fair valuations when we want to exit, and that requires confidence in the value of what we own and a robust market to sell our stake. So first, confidence in the value of what we own or limiting uncertainty. Investors value insurance operations in multiple ways. It's not purely a book value or multiple of EBITDA. It's KPIs, capital efficiency, volatility of earnings, and management credibility. On a forward-looking basis, this is probability weighted by various scenarios on an upside and extreme downside scenario. This is one of the reasons why there's multiple examples in the public sector of companies that are trading at a multiple much different than their book value. So some historical examples of that. AIG in 2015 to 2016 was trading at 0.8 price to book, whereas the competitors like Chubb and Travelers were trading at 1.3 times book. This was partly driven by the U.S. long-tail casualty reserves in AIG, which from their loss development triangles which were published, people could see that the reserves were under-reserved. When AIG announced in 2017 a $5.6 billion adverse development charge in prior years, there was really no change to the market valuation because the market had already built in that estimate. And today AIG trades above book. A second example is Hartford in the early 2010s was trading at a large discount to book at 0.3 to 0.5 price to book. During this same time period, the competitors were trading at 1 times book. This was partly driven by Hartford's asbestos and environmental reserves were too light relative to the peers, also given the market news on settlements. There were other things going on in the Hartford at the time, but this was a large driver. And then when Hartford booked a multi-billion-dollar A&E increase in 2016 to 2017, the stock price did not really move. And now today, Hartford trades well above book value. So the second thing from an investor's perspective is how do we bring new investors into the insurance marketplace, either through investing in stock companies or through sidecars or other features. So we need to create a robust marketplace to sell or exit our investments in insurance companies. So investors need to have predictable range-bound results to place a bid. Too much uncertainty makes it difficult to forecast future results. They give more probability weight to revenue received nearer term than longer term, and that's not just on a discounted time value basis, but also on a probability basis. Investors want reduced frictional costs on past sins and instead have management focus on future profits and opportunities. So one recent example is the IPO and subsequent purchase of Aspen Insurance Holdings. Back in 2015 to 2017, it was trading below book, partly driven by 2017 CATs and other issues that they had at the time. When after Apollo took them private in 2019, there was a large de-risking of the book, including ceding more of their CAT business to the capital markets, purchasing an LPT and ADC on prior year reserves. And the impact of all of this was reduced volatility, increased capital efficiency, and engaged investor appeal. In early 2025, Apollo listed about 14% of the shares in the public market, and then shortly thereafter, Sompo purchased or announced the purchase of a full buyout. And this was largely driven by the reduced volatility in the book. Other recent examples of IPOs that engaged investors after legacy solutions include Skyward and Integrity. So the market often already prices in the perceived uncertainty in reserves or operations, essentially pricing in the cost of a legacy solution. Legacy transactions can reduce the uncertainty range and bring more investors to the table. At the end of the day, we need to have confidence in the value and financial stability of our insurance companies. Summing up, investors and management of insurance operations should regularly leverage the legacy market to de-risk and stabilize balance sheet, optimize capital use and solvency ratios, refocus management and investors, and provide exits for investors. Thank you.
Thank you, Rachel. Thank you. So, Steve, you've got a carrier's view and an investor's view there. Does that resonate with what you're seeing from a cedent side of view?
Yeah, so I'm going to give an Acrisure broker perspective. Other brokers are available. Three things I'm going to talk about. One is what's changing in this space, very briefly. And I'm going to talk about when we talk to carriers, why do they consider these transactions? And then lastly, who are the players in this market? Who are the active people? Firstly, what's changed in this space? I think the biggest change is moving from runoff or distressed portfolios to a performance tool, a capital benefit efficiency tool. That's the big switch. However, I think it's still vital that if you've got a discontinued book, a discontinued captive, that those transactions are still super beneficial to release that. So today it's more about capital efficiency, it's more about profit retention, and as Rachel mentioned, volatility removal. So we really treat this as an extra capital pool. So if you think about, as a carrier, to be the most efficient, optimize your capital structure, optimize your reinsurance structure, you should be using traditional reinsurance, structured reinsurance, cat bonds, retrospective transactions, all of these things combined, the most efficient impact. How big is this market? So the upfront primary market has got 4 trillion of P&C premium, 2.5 trillion in the United States, with 1 trillion in EMEA. Huge market. There are 7,000 US carriers, 3,500 in the little UK, 8,000 in EMEA, and 2,000 in Asia. There's quite a few people to talk to as a broker. We're quite busy, but most have little experience or knowledge of this product. So I think there's a massive runway for growth in this sector, huge. The one exception is perhaps Lloyd's. So Lloyd's, 70% of Lloyd's syndicates have completed a third-party RITC, which is interesting. Market trends, quite slow in Lloyd's activity. 24 was a bumper year for Lloyd's profitability. Surprise, surprise, when you have that profitability, people don't do these transactions. As everyone knows, this is probably the time to do them, because as markets change and things go down, pricing will move out. 2 new things that are happening. Some of the people in this audience can talk about these better than me. Forward exit options, which is something people considered. We need a whole panel session to talk about that. So I'm just going to say that you can buy a position today, so you can lock in a price today to exercise in the future. So that's a real new concept in this space. And also what we call revolving facilities. So you could buy a facility for, say, 22 and prior underwriting year, and then the following year you could add in 23, either on a fixed pricing structure or mutually agreeable pricing. So they're quite significant, clever changes to the space. So when we talk to the carriers, why do they do these things? And surprise, surprise, each CEO and CFO has a multitude of different ideas and concepts and backgrounds. But in the United States, rating is one of the big factors. So holding rating, improving rating, particularly BCAR scores, is a driver. Volatility relief is a big driver, particularly casualty, auto, GL, those lines. Workers' comp, the other way around. So we see people doing workers' comp transactions to generate a P&L release. So some companies are holding, for example, 100 million in reserve. Really, they believe it will probably end up at 70. And instead of sensibly releasing 5 each year over time, you could do a transaction and release all 30 in one position. If we bring the two together, casualty problems and workers' comp relief there, we did a bit of analysis. There were 128 US casualty writers with reserve deterioration in the last 2 years. Many of those have used workers' comp prudency to plug the gap in those reserves. At some point, that prudency will run out and they'll be looking for solutions. I think Andy mentioned efficiency, so operational efficiency, taking out data, people costs in back years, improves combined ratios, so it's a big motivator. Surplus notes, so we've seen examples, surplus notes with expensive rates. So they do these transactions, generate capital, pay that surplus note off, reset it. Dividends to shareholders, enhanced dividends, a big driver. One of the things we try and sell is that in this space, you make most of your profit in years 1, 2, and 3 as a carrier, but you hold infrastructure, capital, people from years 4 to 25. Slight exaggeration in duration, but you get my point. And I think if you remove those back years, you retain the same amount of profit over a smaller capital base. Profit over a smaller capital base is a greater return on equity. So that's really where people should think about using it. Is there any proof to this, what I'm saying? I think Axis Capital and QBE are great examples of proof where they've been market leaders in using these transactions. And as a result, they've got simpler business models, steadier earnings, and improved share price, which is what Rachel mentioned. So I think this trend is all about moving from distressed and runoff to forward-looking return on equity valuation plays. Last piece, who are the active players in this space? Many of them are in this room. So I think the two largest, most successful players have been Enstar and Riverstone. I think they've been super consistent in this market. But you've also got big global reinsurers or large reinsurers that are very active. So you've got Swiss Re, Safety National, Tempest Re, Munich Re, Score Re have all been active. In Europe, you've got Pedigree from Darag, and you've got Compris, super strong brands. And then in Lloyd's with Marco and Premier. But we've also had some new entrants, so it shows the strength of this market. So you had Longtail Re come in with State National. You've got a company called Northern Re and Hale Partnership. Both operate in the United States out of the Cayman. So they're also very active and keen to move in this space. So you've got all these players, there's about 23 of them, not all 23 active on all transactions. It totally depends on business class, geography, deal size, and it whittles down to a much more sensible market. So that's me. Thank you for listening.
Thank you, Steve. Thank you. And then obviously all this sits in a bit of a legal regulatory framework. So Jonathan, is there anything, what's happening on that front?
Okay, thanks very much indeed. Thanks, Steve, and also Andy as well. So I'm going to pick up on a couple of comments that Andy made. So as the lawyer on the panel, it's always my job to deal with the stuff that no one else really likes to talk about. That's always the knotty, gnarly stuff. But today I'm going to give you a positive message. So I'm going to look at litigation. I'm going to talk a little bit about litigation, but from a slightly different perspective. And then we're going to pick up on some regulatory themes as well. And I want to emphasise that both of these are quite positive. So we've already had a little bit of how long have you been in this market type of thing. So I'm not going to indulge in that, but I was Riverstone's first general counsel. So there you go. But in that period of time, for those of you who are around in the market, particularly that period from the early mid-1990s through to the mid-2000s, there was a significant amount of reinsurance, litigation, arbitration across a range of jurisdictions. And at that stage, the legacy market as we know it now wasn't really formed. So a lot of that reinsurance litigation was taking place between what you call run-off portfolios and run-off players. And I can assure you, as a former reinsurance litigator, it was the golden time for us. But times always change, and when the soft market appeared, slowly those disputes disappeared. You have a soft market, reinsurers do not want to tell their cedents, we're not going to pay you. So for a while, there hasn't been any of that kind of intermarket reinsurance disputes. But we are slowly seeing those re-emerging as a result, partly of this COVID. There's a number of different market factors. So those disputes are re-emerging. But the point I wanted to make this morning was that there's been a real relative absence of what I call kind of interlegacy disputes. So if you think about the number of legacy transactions that we've had since 2005, 6, 7, the size and scale of them, virtually none. There are one or two. And we're seeing a few emerge in the ILS market as well, around trapped capital issues, those sorts of things. So there's a little bit of kind of tension going into the market. But I was pondering why does our market actually handle these things quite well? Is it because of, Andy mentioned that relatively speaking, over the recent times, we've had quite a benign claims environment. So in those situations, then, relatively speaking, there aren't drivers for contentious issues. Has the market been really good at pricing? You know, have deals been priced really well? And again, Andy and Steve mentioned about making sure that people got both sides of the deal, got something from it. So if that happens, then again, there's less kind of tension between the players. And does the legacy market deal with contentious issues in quite a cooperative way? Is it because we are a relatively concentrated market, and if you do have an issue, is it better to reputationally or otherwise, is it better to kind of deal with those in a private and consensual way? And again, touching on the fact that the top end of the market, the transactions have grown significantly. Obviously, $1 billion plus transactions have become regular features of that. And one of the things is, you know, is that just sheer scale of that? Is that going to drive some more tension between players? So, from my perspective, though, the messaging overall is a really positive one, which is, you know, 15, 20 years ago, we'd all be suing each other, and now we're not. We can concentrate on doing the deals and not paying my reinsurance litigation colleagues at DWF. And the other side of it was really regulatory. So that's my day job these days, looking at insurance regulatory deals. And it's probably fair to say that for a number of years, across a number of jurisdictions, it hasn't been a particularly conducive environment for commercial legacy transactions. And I'll pick up on a few of the different areas, the EU and the States in a bit. But generally speaking, aside for distress situations where you may have an insolvent portfolio or a scene in distress, generally speaking, regulators have taken a fairly sceptical view. I was delighted to hear that the view from the market was that this is kind of slowly changing, because wearing the kind of lawyer's hat in a number of different jurisdictions, that also seems to be the case. And the proof of the pudding is in the eating, in the old phrase. So what's actually happening out in the market is, for example, in the EU, we've got the IRLA, the new directive for resolution for insurance companies. That gives the resolution authorities in the member states quite a lot of power to deal with run-off books or books in distress. So we can definitely see there that there's an acceptance for a legacy type of outcome as being an acceptable tool. In particular, you've got these ideas of, and the directive talks about solvent run-offs. It gives the member states the power to have resolution authorities with asset and liability separation, terms they use, and also using bridge undertakings as a kind of interim measure. So all of that is a positive acceptance of the skills and the tools that the legacy market has developed over time to be able to brought into a kind of slightly distressed situation. If we look at the UK, for example, we've recently there've been a number of regulatory initiatives there, and the UK had been, I think it's fair to say, the regulatory environment had been kind of quite hostile, really, to things like solvent schemes of arrangement. So some tools, very popular, but no longer so, but with the concept of insurers having to have solvent exit plans, and with the review of transactions over a certain size, then again, the sense of it is that the market is getting more acceptance certainly from the UK regulators. The US, different type of scenario. You have a completely fragmented market, state-by-state regulation, but nonetheless, I think it's fair to say that over a period of time, and there have been some players who have been extremely active in pushing this, there's been a slow acceptance that you need legislation to deal with runoff situations, and that legislation in those individual US states can help you, whether it's some kind of insurance portfolio transfer or whether it's some kind of merger type of legislation. We're seeing more and more US states adopting those because they see them as efficient runoff tools. So again, giving you the legal framework, giving you a legal acceptance that they're looking at a model form of, or they've been looking at model form of runoff legislation for as long as I can remember, which, as I mentioned, is quite a long time. But nevertheless, again, the direction of travel, Europe to the UK, US is generally positive, and it's fair to say that a more conducive regulatory environment can only be good for the legacy market, and also that's a bit of a kind of tribute to the market as well, that because we've not had these disputes, the regulators have been looking more and more kindly on us. So I think we can all give ourselves a little bit of a pat on the back. So as a lawyer, it's a delight to give you a bit of a positive message. So on that upbeat message, I can hand back to Kevin.
Thank you, Jonathan. That was upbeat, more upbeat than I was expecting. Thank you. But just reflect on that. So it does seem to me that my positive feeling from Brighton this year has carried on, in that I think that we are bringing, this market does bring those solutions to get rid of volatility, to give capital relief, that sort of thing. You've got a real capital drive there. The investors are picking up on that, Rachel, definitely, type of stuff. And I think, Steve, given the size of this market, we are really just scratching the surface here, really, what we're doing. There's a lot to go after in this space. And actually, I'm not surprised there's more capital, more players coming into looking at this space, right? Because there's a lot to do here, which is good. We've got a bit of time for questions. If anybody's got any questions, I can happily throw them at the panel. Yep, yes.
That's one for you, Rachel.
Yeah.
So you mentioned kind of an increased want for a robust marketplace. And I was wondering if you could walk through kind of the pros and cons of the difference between Bermuda, where most of these sidecar deals are based, and London, where most of the secondary transactions are happening. For a robust marketplace, which geography do you think would be best?
I mean, there's definitely a marketplace in both. I mean, we have ILS type investors coming in to the marketplace through London Bridge, and then as well in Bermuda there seems to be, I think starting last year, and we'll see a lot more this year, these sidecars coming in to the market, where the investors in the sidecars are typically going to be funds that have a 5 to 7 year life. And so they need to, if you're doing casualty sidecars, whereas the property sidecars, unless it's a trapped capital event, but the casualty sidecars are typically going to need an exit solution for those investors. And so I think we see more of those sidecar type opportunities in Bermuda, and then we have London Bridge, which brings in these alternative investors in the UK. I don't know if anyone else has kind of a comment on that.
I mean, we get lots of people are looking to invest in sidecars and ILS structures, and the key thing is they want an exit or a guaranteed exit. So I think the change in these products, particularly a forward exit option, makes a huge difference. Everyone says you'll exit at 3 or 5. Can you actually exit at 3 or 5? And these products allow you to do so. So I think that's a big change. Yeah.
Yeah, I think, the casualty ILS market, people have been talking about this for 5 to 7 years, and maybe, 5 years ago, interest rates were pretty close to zero. And so you weren't taking advantage of the asset leverage on the return of equity. And then at the same time, people coming out to the investors and making their pitch, they said, well, when you want to exit, then we'll go to someone who might buy it from you. But there was no guarantee of what that exit could look like, whereas now there's these pre-built mechanisms through some kind of option pricing where the legacy market will come out and say, if you want to exit this sidecar, you can pay a small option price, and here is how we will price that exit for you. So they will give you a pre-built mechanism so you know exactly how your exit price will look, whereas before, 5 to 7 years ago, it was just, well, we'll see what the market does. And so giving that kind of guarantee does bring in a lot more new investors into this sidecar space.
I'm going to add my only kind of slightly downbeat comment around all of this, but actually it's not for us, it's for the ILS market, because we mentioned before, again, and it picked up on the fact that we've had a relative lack of large losses that haven't really stressed the ILS structures. But where there have been losses, it's fair to say that the plumbing, the infrastructure behind the notes and the deals, the reinsurance side of the ILS transactions, haven't been quite as well thought through, perhaps, if I can put it like that, because these ILS transactions have been viewed as capital market transactions, not really as reinsurance transactions. And from a deal structuring point of view, the reinsurance piece has probably not got quite as much attention as it deserves. So I've looked at a couple and a kind of sharp intake of breath and thought, I hope they don't have any losses on that. So it's probably fair to say that in the ILS market, we're going to see when the big losses come, because they always come, we just don't know what they look like. We are going to see some tensions in those, which I think will probably have some knock-on effects for the legacy market as well.
Isn't that going to just dampen the market then, if you take that sort of risky approach? So it's hard enough to price something today, but pricing something for 3 years' time is going to be quite tricky. Then if you get the lawyers involved trying to de-risk that, the product's pretty soon not going to be really worth the paper it's written on, surely. So, observation rather than a question.
I mean, the product obviously suits property cat business because it's all about volatility or less volatility. So it's easy to price an ILS property cat forward price than it is anything else. But I mean, it's a trend that, and you're also going to pay more for a guaranteed exit today than you would if things went well and you did it in the future. It's going to be a better price. But clearly the point is, if things go well, they don't always go well.
Sure. So I think there has to be a bigger risk appetite, doesn't there, in order for this to happen?
Yeah.
And that was going to be my general question. The legacy market grew out of quite a lot of live companies going to run off and some into insolvency in the 1990s. It seems that the world has changed quite a lot from those days, in that we don't seem to be having those sort of failures anymore. Is that a good or a bad thing for the legacy market? And is there anywhere that we can see that we will enter into that sort of space ever again, where it's a little bit more volatile and the whole insurance stuff is a lot more efficient from some ways, from a pricing perspective, but inefficient in that we have people failing?
I mean, I think as Steve said, there's these products where it's being used as a form of capital. So instead of doing a surplus note, maybe you have an LPT, and that provides reinsurance capital as opposed to debt capital, if you've kind of maxed out or if you're not able to get the debt product. And then you can have these repeat structures where you roll in each new year into the product, which is repriced each year. But it is another form of capital if you're unable or you're maxed out on your debt, and you would prefer to have it be reinsurance capital.
I mean, it's a good question. So I think you see more driving through investor pressure on returns. So the return isn't good enough, so they would exit the line. I think you see, rather than insolvency and I think that, and then Rachel's point about just the efficiency and the return on equity that you're trying to generate. So I think the product's moved with the trend, I think.
Yeah. And my take on that, go back to the years ago we were talking about, you need £2.50 to set up an insurance company, off you go type stuff. You can't do that these days. With regulation coming, capital's in the industry, right? It's got bigger and bigger and bigger, and it's not going to go away type stuff. So what you are then looking at is capital efficiency and things at the margin. When actually this market's been pretty good at working out how do you provide solutions to get better ROEs for the life carriers, right? And that's what it's doing now. But you never know what comes down the track, right? There's things out there that, where it's climate change or PFAS, something could come and shot the marketplace, and we start all over again. Asbestos too. Who knows?
Yeah.
Andy.
Yeah, question for the panel. A couple of years ago, there was lots of sort of talk about claims control on legacy deals. Interested to see what sort of Steve is seeing from the cedent side. Is there a preference from the cedent? So I guess from Andy and Rachel's side, is there always that preference to sort of use the USP of the legacy market on claims? Just interested to see what that is.
Do you want to kick off cedent side first?
Big difference in view. I suppose the general trend, Andy, is that less people, or less carriers, they can, obviously Andy will speak for himself, but I think less of a, you must control the claims. So I think there is more oversight type transactions than there ever used to be, almost like traditional reinsurance, audit rights, inspection rights, you see. I think there is a difference between the retail and the brand point than there is the commercial reinsurance transactions. People are still very sensitive on the retail space about, you do a deal with Aviva and it's Aviva's customers, Aviva's brand. Do they want to swap it to Riverstone or Enstar or Compris? But I think the strength of the market, the strength of Enstar and Riverstone have changed that perspective a lot. So I think it's moved.
Yeah, I think on the claims handling side, Compris has a large, capable team to do the claims handling. But as far as the actual opportunities that we see in the market, we're seeing more opportunities where they want a capital solution, but they don't necessarily want to give up their claims handling. So it seems like it's moving a little bit more towards legacy can be seen on a spectrum of claims support and capital support, and I feel like it's moving more towards the capital support side. But maybe it's different for Riverstone.
Yeah, I'd say it's definitely not a binary point in my mind, Andy. It's there's a few things to say in here. One, yes, I think generally you would say that there is an appetite for us to take over claims control because we think it's a differentiating factor and we think that we can drive better outcomes in the runoff, which creates that incremental value that I talked about earlier in terms of being able to price deals better for everyone, which I think is true. But the other point here to consider is that our business at the core and the coalface itself is not all directly claims handled. So much business that we've taken on over the last few years is DCAs, TPAs, FGAs. So we also have over many years learned to be TPA oversights and do TPA audits, and we can still drive value in that way. So even if we don't have direct claims control, we're still able to influence better outcomes through oversight, through claims coordination, through audit. So we can still get to a good outcome. So it's not a binary point. I think it depends on the line of business as well. It depends if you're reinsuring reinsurance or if you're at the direct phase. So, it's a real mixed bag that fits into this business. And, again, I do think, as I said, fundamentally, we believe we drive better value if we have that control, but very flexible approach depending on the type of structure. So.
Thank you. I think we will call it time now because I suspect some people may want to get on for 9:30 meetings. A bunch of us will still be around afterwards if you want to catch us for one-to-ones afterwards. But can I ask you to thank the panel for their contribution this morning? Thank you very much.